What if the most powerful tool in modern economics isn't oil, technology, or even military strength, but the ability to create money from nothing? At first, that idea sounds impossible. Money has to come from somewhere, right? Work, resources, production. But in today's financial system, new money can appear with a few keystrokes inside a central bank. No gold mined, no taxes collected. No goods produced, just numbers added to a ledger. The official explanation is that this helps stabilize economies during crises. But there's a deeper question that few people ask. If money can be created so easily, what is the hidden cost? And more importantly, who ends up paying for it? For most of history, money had physical limits. Gold and silver coins were valuable because they were scarce. Governments couldn't simply create more without mining new metal. This scarcity imposed discipline on economic systems. But as global economies expanded, those limits became inconvenient. Wars were expensive. Economic crises demanded fast intervention. Governments needed flexibility. So financial systems evolved. Paper currency replaced metal coins, and eventually modern fiat money emerged, currency backed not by physical assets, but by trust in governments and central banks. With this shift came something unprecedented, the ability to create money on demand. The modern era of money creation accelerated during the 20th century. Central banks were given the authority to expand the money supply during financial stress. At first, this seemed reasonable. If banks collapsed, liquidity could be injected. If economies slowed, borrowing could be encouraged. But the cause and effect pattern began quietly forming. When new money enters the economy, it does not spread evenly. Financial institutions and large asset holders receive it first. They invest it while prices are still low. But by the time that money reaches wages, goods, and services, prices have already risen. This creates a subtle shift in purchasing power. Money printing doesn't just increase supply, it redistributes wealth. Over time, central banks expanded their role in managing economic cycles. Interest rates were adjusted to influence borrowing. During recessions, stimulus programs injected massive liquidity into financial markets. One of the most powerful tools introduced was quantitative easing, the process of purchasing financial assets with newly created money. The idea was simple: increase liquidity, stabilize markets, and encourage investment. But each intervention created a new dependency. Markets began expecting support. Governments increased borrowing. Debt levels climbed. The financial system slowly adapted to a world where new money could appear whenever instability emerged. But every expansion carries risk. When money supply grows faster than economic production, purchasing power declines. This appears as inflation. Prices rise. Savings lose value. The cost of living increases. Yet asset prices, stocks, real estate, commodities often rise even faster. Why? Because newly created money tends to flow first into financial markets. The result is a widening gap between asset owners and wage earners. The same tool used to stabilize economies can also deepen inequality. The consequences of unlimited monetary expansion rarely appear immediately. They build slowly. Debt levels increase. Governments rely on borrowing instead of balanced budgets. Markets become dependent on low interest rates. Each crisis requires even larger interventions. What began as an emergency tool gradually becomes a permanent feature of the system. The paradox is that printing money can temporarily solve economic problems while quietly creating new ones beneath the surface. Central banks attempt to manage these risks through policy adjustments. Interest rates are raised to slow inflation. Liquidity programs are reduced to stabilize currency value. But these solutions often trigger new problems. Higher rates slow economic growth. Debt becomes harder to repay. Financial markets react sharply, so policymakers face a difficult balancing act. Tighten too much, and the system stalls. Print too much, and the currency weakens. The cycle continues. Today, the scale of money creation is larger than ever before. During recent global crises, trillions of dollars were injected into financial systems within months. Markets recovered rapidly, but inflation surged across many economies. The pattern repeated once again. Crisis, monetary expansion, asset inflation, currency pressure. The system survives, but only by growing larger each time. First, The power to create money is one of the most influential tools in modern economics. Second, monetary expansion does not affect everyone equally. It redistributes purchasing power across the economy. Third, systems built on expanding debt often depend on expanding money supply to remain stable. Printing money can stabilize economies in the short term, but history shows that every form of monetary power carries hidden consequences. The real question isn't whether money creation will continue. It's how long the balance between growth, debt, and currency stability can hold. If you want to understand the deeper forces shaping global finance, from central banking to debt cycles and monetary history, subscribe for more in-depth breakdowns, because sometimes the most powerful forces in the economy are the ones created from nothing.